I asked my subscribers to give me some stocks that they wanted me to analyze, and today is the day I do just that. I have two stocks that my subscribers recommended: TE Connectivity, ticker symbol TEL, and Automatic Data Processing, ticker symbol ADP. Shout out to Osvaldo Perez 6979 and Alex Rose Gaming for the recommendations. Let's get into it. We'll start with TE Connectivity. Apparently, it's in the same industry as ASML and only second to ASML. So I looked up what they did, and Google said that they design and manufacture connectivity and sensor solutions for various industries. I have absolutely no idea what this means, so I asked AI to explain it to me like I was in elementary school, and it said this: Imagine the tiny nerves and plugs that let machines sense the world around them, talk, and get power. That's TE Connectivity. They build the essential but hidden components, connectors, and sensors that make your car smarter, your phone work, and factories run. They're the builders of technology's nervous system. So basically, just like ASML, they're another company that just allows a bunch of other tech companies to work. And according to some of their presentations, they want to be the main infrastructure provider for electric vehicle automation and robots and AI and cloud computing. But aside from this, they also plan to hone in on their products they already have and really just create more durable and efficient versions of them. So we got kind of the summary and their plans for the future out of the way. Let's move to Seeking Alpha to actually look at some of their numbers. So looking at TE Connectivity, over the past year, they're up 15%, and over the past 10 years, they're up 179%. If we just kind of do a brief skim over some of these articles, benefiting from industrial automation and robotics, initiate with buy, resorting to MA to improve growth and positioning, expecting Q4 results to be a little more electrifying, strengthening fundamentals, higher multiples, justify re-rating. Some of these people, or a good chunk of these people, are pretty bullish on this stock. But let's just look at some of their numbers. If we go to the financials, we can see their total revenue has been fairly consistent for the most part. It did take a dip in September 2023 and 2024. And I actually have Webull pulled up on my phone as well. And in 2023, their revenue fell 1.5% in 2023 and 1.1% again in 2024. Now, so far in 2025, in the most recent quarter, they were up 4.4% year over year. But, we'll see how this plays out. Now, keep in mind, TEL is a bit of a cyclical company. 44% of their revenue comes from the automotive industry, which is just inherently cyclical. So it's not going to be the most perfect graphs. Some people may not mind that. Honestly, I don't know if I'm a huge fan so far, but we'll keep looking through this. Their gross profit has pretty much been going up over the past 5 years. Operating income, kind of same thing. It's basically been going up. 2023 wasn't the best year for them. But if we look at their net income is kind of all over the place. It was down in 2020. That's not really good, but they've kind of picked it up since then. Although trailing 12 months is down a lot. Keep in mind, again, this is a cyclical company, but let me just look at their net income on Webull. In the most recent quarter, they're down 97% year over year. I really don't like to see that, to be honest. But apparently some of these other people are bullish. Maybe they have better reasons than I do. But net income in the most recent quarter is down year over year. In Q1, it was down 70% year over year. But let's look at their free cash flow, because this is something that I actually do like. If you're unfamiliar, free cash flow per share is probably the best metric, or it's at least one of my favorite metrics when looking at dividend growth companies. And if we look at their free cash flow per share, it's actually pretty nice. It's pretty much only gone up over the past 5 years, and trailing 12 months, it's even higher than it was, and it's seen pretty rapid growth so far. That is a good thing. That's what I love to see that. So maybe their net income and their operating income isn't too great, but their free cash flow is looking solid. But let's look at some of their dividends. So they've been consistently paying dividends for 17 years, and they've been consistently growing dividends for 14 years. That's good. They have a good track record of paying out dividends consecutively. If we look at their dividend safety, they pay around 25% in their free cash flow. That is really low. That's really affordable. That basically means that they can pay out their dividends almost, not quite, but almost 4 times over. Because why not? Let's look at their dividend yield, about 1.63%. But let's look at their dividend growth. This is obviously, as a dividend growth investor, one of the most important metrics. If you look at their 3, 5, and 10-year CAGR, they've averaged somewhere around 8% growth over the past 3, 5, and 10 years each year. That is good. That's good dividend growth. It outpaces inflation. Personally, I don't really like to see that. That's not as high as I would like it. Just because I'm young, if you're a bit older, that might still be solid. But right now for me, because I have a super long time horizon, I want some of the highest paying companies. I really try to aim for at least 10% minimum. Unless it's like SCHD, SCHD has averaged like 10, 11%, but I'm, shooting for like Microsoft 10%. ASML has been growing on average like 20%, which is just nuts. But somewhere around there, Intuit was somewhere around 14, 15%. Those are the growth rates that I like to see. 8% is still good, but I'll leave that for later down the line when I want to get into, maybe I'll want to get into this company in the future, or like Caterpillar. Caterpillar's a company I really want to get into, but they only grow somewhere around 8%, and I'm really just not entirely worried about it for where I'm at in this stage of my life. But if we look at their margins overall over the past 5 years, they have been going up. Let me just pull this up so you can see what I'm talking about. So yeah, margins over the past 5 years has gone up pretty heavily. In 2020, it was 30.69%, and now we're at 34.87%. That's what we like to see. They're becoming a more efficient company. And I just wanted to rattle off a few more things from my phone that I can see on Webull. So I think I said earlier their net income was down 97% year over year in the most recent quarter. But if we look at it from an annual perspective, fiscal year 2024, their net income grew 67% year over year. That's really good. And in fiscal year 2024, their debt to asset ratio went down by about a percentage point. But if we look at it from a quarterly perspective, in the most recent quarter, it shot up 4%, which I don't really like to see. CFO in the most recent quarter was down 8% year over year. But if we look at it from an annual perspective, fiscal year 2024, it was up 11% year over year and has seen pretty consistent growth over the past 5 years. If we look at some of their other metrics, they do buy back shares. They don't buy back a ton of shares. Well, I guess this has proven me wrong. Fiscal year 2024, they bought back almost $2 billion worth of shares. But so far in 2025, they've only bought back $296 million worth of shares. They also took on some debt in Q2 2025. They took on $1.3 billion worth of debt, which I'm really not a fan of. But in the most recent quarter, they were sitting on $2.5 billion worth of cash and equivalents. So it's not the worst thing ever. But I'll give some of my thoughts on the company later. For now, let's just move on. Stock number 2 on the list today is Automatic Data Processing, ticker symbol ADP. Dividend Data just posted a video where he talked about this, but I swear I was already going to talk about them before it came out. But anyways, DeepSeek calls it a digital helper for businesses so that companies can focus on their actual work. And it gave me a slightly more in-depth breakdown of their core business. They handle payroll processing, human resources management, employee benefits administration, tax services, time and attendance tracking, and analytics such as labor costs and compliance risks. Since they have such a wide array of resources, pretty much any company can find them useful regardless of their size. But what are their plans for the future? Like most companies right now, they plan to use AI to automate a lot of their tasks, which is good, but that's not what I want to focus on. Aside from that, they also plan to unify global payroll and HR all onto one platform. When I hear that, It sounds damn near revolutionary. Right now, they believe it's a bit fragmented with a bunch of country specific systems, but they plan on expanding ADP Celergo, which is their global payroll engine, and they want to use ADP Data Cloud for cross border analytics. Basically, what I'm hearing is that they have a clear cut and reasonable path forward. It's sounding good so far. Everything has sounded great to my ears. I don't know about y'all, but let's go to Seeking Alpha and look at some of their numbers. Over the past year, ADP is up 32%. Over the past 10 years, they're up 278%, and their dividend yield right now is about 1.99%. Now, if we look at some of these articles, upside profile is not attractive enough, resilient cash flows and undervalued earnings potential, promising growth potential but expensive, perpetually overvalued. You know, you can kind of just look at all these. Most of these people kind of think it's a bit overvalued. Maybe. I'm not here to deny that. But let's look at some of their financials. Maybe there's a reason they're overvalued. Their total revenue has seen consistent growth. It's been beautiful. Consistent growth to the upside over the past 5 years. If we look at their operating income, pretty much same thing. Seen consistent, steady growth over the past 5 years. Trailing 12 months, higher than ever. Net income, same thing. smooth line up. We all like to see these. Let's look at their free cash flow per share, because just because all this looks amazing doesn't mean their free cash flow is. But if we look at their free cash flow per share, it's pretty much the exact same thing. It dipped a little bit in June 2024, but now we're way higher than we've ever been trailing 12 months. Their free cash flow has seen consistent growth. These are the companies that I like to see, where every metric is just a smooth, beautiful, clean line up. They're not really, it's not too volatile. It's pretty consistent. And maybe they're overvalued. It may not be the best time to buy them right now, but regardless, overall, this is seeming like a good quality company to me. They've been paying dividends for 49 years consecutively and growing dividends for 26 years consecutively. That's amazing. If we look at their dividend safety, their cash flow payout ratio is kind of high. It's higher than TEL was, 56%. But honestly, that's still fairly sustainable. I really believe anything under like 60% is good. Even 60 to 70 isn't terrible. But, 80, 90%, anything above that, that's not the best. But 56%, that's sustainable. If we look at their dividend growth, this is what I really liked when I just kind of skimmed through this originally. Look at these growth CAGRs. 3, 5, and 10 year, all seeing above 10% average growth. Over the past 3 years, they've averaged 14% dividend growth. So that's not to say they'll maintain this growth, but we could potentially see faster growth in the coming years. Obviously, past performance isn't indicative of future results, whatever. But over the past 10 years, they've averaged 12% growth of their dividend every single year. That is amazing. As a dividend growth investor who has a long time horizon, again, I know I've kind of said that over and over in this video. These are numbers that I really like to see. I'm very happy with what I've seen so far. I could safely say, just with the knowledge right now, I would be comfortable putting my money into this company. But let's look at a few more things. We can go over their gross margins. Their margins have been rising over the past 5 years. In 2020, it was at 44%, and now in 2025, it's at 48%. Overall, everything is looking really good so far. I haven't found anything wrong with this company. Now, whenever I went over to Webull, I did find some stuff. So, again, we talked about how their net income has seen consistent growth. If we look at fiscal year 2024, it was up 9.96% year over year. So almost double-digit growth that year. And if we look at their CFO, it was down 1.19% in 2024. But in Q2 2025, it was up 11.42% year over year. But here's what I want to talk about. Their balance sheet. Now, this might be the reason why why a lot of people think they're overvalued. Their debt to asset ratio in Q2 is 92%. They have so many liabilities, and from 2020 to 2022, their debt to asset ratio rose almost 10%. It has been going down since 2022, but it's still extremely high. That isn't really what I like to see, but everything else has looked so good so far. They also buy back shares, so you're getting non-cash dividends as well. It's ranged anywhere from about 250 million to almost 500 million that they buy back per quarter. They did issue 5.36 billion dollars worth of debt in Q1 2025, but then they paid off 4.3 billion in Q2 2025, and they're sitting on 2.6 billion dollars worth of cash and equivalents right now. Really, the only thing that I didn't like was their debt to asset. I might be willing to look past that with how good everything else looks. If we look on FinViz, I just have it pulled up on my phone in front of me. Their return on invested capital was 43%. That is so high. I love to see that. That is one of my favorite metrics to look at. Their forward PE is 28, but their PEG is 3.5. So, yes, that does likely suggest that they are overvalued. And I forgot to talk about this earlier with TEL, but TEL's return on invested capital is 9.06%. That's not that high. I really wish it would have been higher, but their PEG ratio is also 3.75. So, again, likely suggests they're pretty overvalued right now. But let's just summarize this real quick. TEL is a lot more volatile because of its cyclical nature, but it has seen consistent free cash flow growth, and it's been consecutively paying and growing dividends faster than the rate of inflation for quite some time. I will say I would like to see higher dividend growth rates, and I'm not the biggest fan of their volatility. With ASML, I was willing to look past it, considering that they're the only company in the world with the EUV lithography machines, but personally, I just think there are better companies to invest in. ADP seemed great with everything: consistent net income and free cash flow growth, very high dividend growth rate, and they have a clear path forward. They're also a dividend aristocrat, which I didn't even mention, but their debt to asset ratio is really the only thing that I somewhat had a problem with. That's just something to keep in mind. But overall, I really like the thought of ADP, and I wouldn't mind putting my money into them. But with all that being said, that's pretty much all I got to say about the stocks. Again, shout out Osvaldo Perez and shout out Alex Rose Gaming and shout out Doodle. He's been like my number one commenter on my entire channel. Hi Doodle. And he actually gave me this video idea. Doodle, where you been at, man? I've been missing your love, bro. Anyways, I hope you got something out of this video. If you did, consider leaving a comment, consider subscribing. I would really appreciate it. Other than that, good luck on your investing journey.